Ladies and gentlemen, today we will start our journey in the field of risk management in finance with a topic which can be absolutely familiar from corporate finance. So when we start the book, the first chapter is completely trying to establish what we know already about portfolio finances and risk management. So since it would be really boring, I would like to show you that how can we do the same things in Matlab, and also we will go through how can we automatize different parts and how can we extend these things with our already existing knowledge based on international financial management. So when we have to talk about return and risk, obviously we have to start with the data generating process. So usually we are assuming that we have some kind of price of an asset which is generated somehow, and finance was always assuming that this thing is building up like an autoregressive process. So we are thinking that okay, there were the previous values of the price, it's weighted with a beta, so it's not counted as 100%, just with a lower weight, and there is also some random value, and then it pushes the price back and forth. And we can have also some assumptions that, yeah, in the case of efficient market hypothesis, people are thinking that this is supposed to be normal distributed, and we have only one leg, because if it would allow to have multiple legged values, then it would have a memory and it would not meet the requirements of efficient market hypothesis. So if we are generating some random data like this one, then we could have something which is meeting with the efficient market hypothesis. So let's see. If we are running this thing, or we can build this thing up. Oh, sorry. Now I can have Matlab. So you can download it from CodeSpace or at the seminar part. You have it, and you can remember from Matlab from the last semester. So in the editor, or if you are just clicking on the M file, then you can find the script part. Okay, right now in the download, so let's move this thing to the Matlab folder, otherwise strange things can happen. So documents Matlab. Okay. And also I have to move myself because it's here. And this is the workspace where we are putting all the outputs and interim calculations, and this is the command window where it communicates with us. So yeah. So the first part is about generating this data set. So okay, we start with a clear. I did not want it to care about the constant, so it's set to 0, so there is no drift in the procedure, and also the beta was set to 1, so all the trust data is built in to the data generating process, which is sometimes it can be questionable, but we will see. So I will show you what kind of issues can be raised, and the start value is 100, and after that we can see that this is completely generated by white noise. So random numbers are coming from normal distribution, so there can be some extreme values, but mostly it behaves in a nice way. So, and yeah, this is generating from This is just one time series, so this whole simulation is just 100 data or 1000 data points. So if you are running this part, then we can see that yeah, it behaves like a price at the stock market, so it looks like as a company which is failing miserably because they were halving their price. Obviously, from simulation to simulation, it will be different. So, and well, we can have issues with the beta parameter. So if we would set it to 2, then it can create some issues. So you can see that this is exploding. So like it's going up to 10 on the 302. So practically it cannot exceed the value of 1 that much. Yeah, it's if it's just 1.1, it's already has this exponential nature. So 1 is the threshold. Otherwise, it starts to behave funny. So usually it can be 0.8 or something like that because no, it cannot be also lower. Yeah, this is because if we set it to significantly lower than 1, then it will start to behave like a return already. So you can see that it starts to fluctuate around 0. So if it's still 9, yeah, it's not operating as a price anymore, which is funny. So if you don't want to differentiate the data set, then you can set it to lower numbers. If you want to use it as a price generating process, then it can be 1. And obviously, if we would like to create a much more realistic data set, then this beta, or sorry, the past values should be involved much more. So right now it's an autoregressive 1 process because it only assumes the previous day's values, but usually the lag number can be as high as 30 sometimes, and under normal circumstances. So if you are checking Dow Jones Industrial or Standard & Poor's 500, even during peaceful times, so it's not a recession period or something like this, the autocorrelation, so the past days can be reaching 30 days of memory. Some part of the literature says that practically this should happen only under stressful times, but when we check the empirical data from the last 100 years at Dow Jones Industrial and S&P 500, it was not significant. So we were able to see half of these days were completely not under recession time period. So this is one thing. The other is that we can change these random numbers to a fat tail distribution. So if these random numbers are generated by a student distribution, then it will contain much more extreme days, and that's why it will be much more realistic. Yeah, but right now let's test what works according to the assumptions, and after that we will start to play with the numbers here. And to make everything consistent, that's why I created this time series or random generated data here, because at least we can see that, or we can check the same things. So later on, if we would like to have some kind of common data, then we will use this Excel sheet. Okay. And of course, we are not operating at the level of prices, so we have to take the differentials to organize everything around 0. And then we have our usual returns, and these returns have the usual behavior. So if you are generating a data set randomly like this thing here, and after that we are taking the differential, then it always looks like this. So until we are not adding additional memory to the data set, and also until we are not adding fat tail distributions or heavy tail distributions which contains much more extreme values, then this will behave nicely. So we can see that, okay, the expected value is always around 0 if we are taking the differential, but also the distance from the 0 is not so high, and also we can see that usually the level of volatility is also quite the same. So we don't have huge volatile periods and low volatile periods. Maybe, okay, we could say that this one is smaller than this one here, but otherwise it's quite smooth. So if you have to push it everything together, then we can get this normal or distribution, or this one is a histogram right now, and after that if we fit the normal distribution on it, we can see that no, it's behaving a nice way. If you would like to do the same thing in Matlab, then yeah, we have already the return, and in the applications we have the distribution filter, and once it's loading in, then we can set the data to returns, nothing more. Yeah, create data set, yes, okay, we have to select this one, and after that we can fit different distributions. So we can say that, okay, we can set it normal distribution. Let's apply this. After that, it provides us the necessary informations, and we can see that, yeah, we can parametricize the normal distribution with just two parameters. First is the expected value from the time series, which is close to 0. So right now we can see that it's 0.007. And the other thing is the standard deviation, the sigma here, which right now it's 1 because we use standard normal distribution during the data generation process, so it's highly expected that the first one will be 0 and the second one will be really close to 1. And well, we don't have any further data here, so let's close this one. And after that we can see that, oh, it's fitting nicely. So first of all, the distribution dies off quite fast. So we don't have a huge distance from the expected value here. So most of the data is around the expected value, so it behaves also nicely. We don't have fat tails, so don't have so much extreme values. Okay, we can see that, yeah, there is something and here is something, but everything is allowed by the theoretical distribution as well. So this is a nice thing. And of course, this part of the script is describing this one here, so it's quite useless. But otherwise, if you would like to assume that this one is much more realistic, then, or we would like to test that, okay, but let's add real time or real values. So if we would test this data set, then we can see that it's really far from the optimal circumstances. So let's say that I'm clearing out this one. It seemed to be a great idea to include this, but no, it's not. So let's test. Real market data with different frequencies. So data equals XLS read, bracket opens, upper apostrophe theta flatline frequency dot xlsx and let's just play with the daily data set. So if I'm using this one and it's imported, and after that we can test the dataset for the different properties. So let's create a nice, we will create a nice for cycle, but right now let's just create a descriptive analysis of all the data. So output first row 3 column equals the mean of first we have to stop because we have some considerations to deal with, because okay, let's focus only on the differential of the data. So we don't want to use logarithm today because everything would be really nice except when we are reaching the stupid interest rates. Because as you can see here, the interest rates in Germany or government bond long-term yields were negative, and if I'm taking the logarithm of this, then it will be utterly useless. Just the problem is that in the case of books and ducks, the values are too high. So, or maybe we should just test the brand. Ah no, we should test everything. So, okay, let's just use differential. What can possibly go wrong? Diff data. That's why I hate yields and interest rates. They are always messy. Okay, so we have the mean. Let's have also the standard deviation. And also, what do we need? And it's also completely forgotten by the book, that the data set is never symmetric. So the market is always growing or shrinking in one direction. Okay, if you are checking the US dollar euro exchange rate, usually they have this sinus curve like behavior. So okay, they are going sideways, but all the other market assets which are available possibly on the market, they have asymmetry. So that's why skewness must be checked and tested. So this is about asymmetry. No. Yeah. If it's not zero. And also what is really important for us, because the extreme value must be checked, because if the kurtosis is 3, then it means that we don't have so much extreme value. Still, at the tails of the distribution we can find something, just it's not that common. So that's why kurtosis must be verified, because if it's far from 3, then we can have bad times. And okay, since we have so many tools, then obviously we should check also the normal distribution. Is this normal distributed or not? Okay, if everything fails here, so it's okay, the mean will be around 0, but if the skewness and kurtosis, this one is not 0 and this one is far from 3, then normal distribution will fail automatically, because Jacques test checks for this the third moments and the fourth moments of the data. So after that it doesn't matter, but still it's nice to see. So Jacques test. We should do this. No. Okay, just the first output is the hypothesis that it's normal distribution or not, but the p-value what I'm looking for is the second one, so that's why it looks this stupid way. Okay, so if the p-value is bigger than 0.05, then normal distribution is in the data. If we are failing to meet this, then after that we have to be really careful and much more aware at the whole risk management procedure, because we have much more job to do, otherwise it would be quite a boring thing. And of course we started the entire simulation that, oh, just the previous day must be added during a simulation. So it's an autoregressive process. But we should test for autocorrelation, so that's the Young box test. And we have to copy this one. And the official version is quite stupid at the level of scripting, so there's no problem here at the outputs, but at the input side, so we have to say that I think it was legs, and we have to set it to 2. So let's see that does it have memory at 2 days backwards. So if p is smaller than 0.05, then it has autocorrelation. Sorry. Leg 2. Was it legs? I know that it was, yeah, it's legs, okay. Also, we should end this bracket. And the last thing, but it matters a lot because this is what requires us to use Garch models later on when we are fitting any VAR value at risk models, or when we are fitting the option pricing and so on and so forth, is that the time variant nature of the standard deviation. So under the standard model, we could see that the standard deviation is fixed in time. It's not changing at all. But if the dataset is heteroscedastic, so we can see that volatility is changing in time. So sometimes volatility is big, sometimes it's small. Then we are completely messed up, our entire risk management system, and we can have the same issue what happened with the long-term capital management in 1998, when they went down and US Fed needed $3 billion to consolidate them to avoid the collapse half of the global options market. So yeah, RLM test can be useful. Arch test. Yeah. And the inside can be completely the same like before, so heteroscedasticity happens. Heteroscedasticity happens. So the STD is changing in time. The standard deviation. It's time variant. And usually at higher frequencies, at daily data, we can see that this is. But if we start to use lower frequency data, weekly or quarterly, then it starts to disappear because practically we are picking up time points. And after that, we are not able to see this thing anymore. And especially at high frequency trading, so if you are checking data which is generated at minute or hourly basis, we can find the same thing. Just at that time, it's really hard to estimate because you are oversaturating the estimation model. So sometimes Garch model is failing to fit on this, or it will be really stupid. Once we had a paper with the guys, and it was okay, we were able to do this, just it would require much more time. We got some error messages, but it is yellow, it's not red, so it's working completely well. Just it says that the p-value is so small that it will adjust 0.01 instead of 0.0000. Yeah. Okay, so first run, it was working well for g equals 1, so for the Brent only, so now we can create it for the entire 8 data points. So this is the benefit of Matlab, because once we are able to write this routine, then after that we can generalize it for all the time sets, and after that we can see that how deep is the problem. Usual data, decimal points and decimal commas. So let's remove this. Oh, sorry, I'm using Hungarian speaking things, but yeah. After some formatting, so we have the mean, we have the standard deviation. I'm zooming in because it can be highly non-visible. Normal distribution. Autocorrelation. Heteroscedasticity. So the ideal values would be 0 here. In the case of standard deviation, it doesn't matter. So if it's bigger, then it's more riskier. So we don't care about that one. In the case of skewness, to have well, do we use 2 epsilons or just 1? It looks so stupid. Yeah, 2. Okay. Yeah, because if I'm writing it with I, it's even more stupider. So okay. Okay, cool. So this is 3. So extreme values. Normal distribution, so the p-value should be bigger than 0.05. Then autocorrelation should be smaller than 0. Or sorry, to have autocorrelation, so like will be bigger than 1 if we can find autocorrelation, and if we are using any kind of model, so we should increase like number if we have such a setting, if we find autocorrelation. And if heteroscedasticity is present, then it means that STD has memory. So the consequence will be that gauge models are, some kind of gauge model will be needed. And yeah, let's see. Yeah, I should bring this backwards because I need coloring. So, yeah, this is what happens if I'm not using logarithm books and docs. This one is ugly. Yeah. Okay, we can see that this is still close to 0, just the fluctuate or the volatility is so high because it's measured in tens of thousands. So let's not ruin our data set. So let's say that we are taking the natural logarithm of the last 2 data. Now it's more beautiful. Oh, shit. Now it's nice. And also the standard deviation is not that crazy anymore. So, okay, I could also divide by 10,000 and 1,000, but yeah. Okay, standard deviation, it has some values, but practically we could say that skewness would be not biased by the logarithm, so it doesn't matter that are we using logarithm or not. If something is not symmetric, then it will be remain the same. But if you are looking on natural gas and euro US dollar, we can see that it's quite close to zero. So it's close enough to highlight it with green because okay, that's not it also. Also German government bonds. But the rest we can see that yeah, it has a tendency to go up or down, mostly down. If you are looking on the kurtosis, these are the problems here. So we are completely far from 3. So these markets are already failing to meet the efficiency requirements. Some people are saying that efficiency is only coming from the lack of autocorrelation, but if we are checking the original article which defined market efficiency, then in the appendix it was required also to have normal distribution, just as a footnote, because when I had to defend my thesis as a PhD student, I get also this feedback that why am I so rude against normal distribution because it's not required, and after that I had to dig up original paper and yeah, it's required. Okay, so if you are looking for memory, then okay, memory is missing at the case of the coal, at the case of the euro, US dollar, and somehow for some reasons in the case of the DAX, which is surprising for me, but I did not mess up anything, so surprise. But this is the funny part. So if you are looking on floating exchange rates, so if you would add further and more floating rates, usually they are behaving or they are really close to the requirements of efficient markets. So you can see that also their kurtosis is way lower than what we can see in the case of the stock markets. And usually in the case of bond markets, just maybe we are lucky with the sampling, because they are usually much more crazy, or they are much more stable compared to the commodities. So even if they are not directly managed by central banks, still they are much more efficient than the stock markets. And yeah, heteroscedasticity. So that's why Gauss model is our friend. And if we are doing the same thing, let's say that, okay, but we are working with weekly data because we are not so active as a portfolio manager, then the problem will remain the same. So let's change everything. So I would like to keep this. Okay, and we have to clear up everything. Otherwise I would overwrite and we could create really strange values. First, let's change the stupid commas. And then formatting. Oh, let's copy everything. And if you are working with the weekly set, we can say that it's similar at the level of in the case of the skewness, we can see that yeah, we started to remove data sets, so that's why it's much more still German bonds kept their close to symmetric nature, but we can see that the rest is elimination destroyed. And also we can see that the sign, so it was negative before, now it's positive. So practically this is a missing data situation, which is usually not considered, but we can see that it has additional bias if we are changing the frequency. And yeah, we can see that with lower frequency we start to have, I mean not at green, but at least yellow to this. So now we have something which is less extreme, but still normal distribution fails, so it's not that great at all. But autocorrelation, it's starting to disappear. So since we were handpicking data points, then obviously now we removed the previous days and the days before and so on. So now it's clearing up, but heteroscedasticity completely terrible. That's why I like to work with weekly data set, because we don't have to care about so much with the synchronization, so we don't have this, oh, this workday is missing here and there is a national holiday, that the market was frozen and so on. Okay, it has some biases at the level of autocorrelation, but otherwise it's still completely flowed. And if we are moving to the lowest frequency, so quarterly data, we can see that it will be much more nicer. Yeah. Okay, except the mean. This poor mean is due to the sampling's nature. Oh my, standard deviation is also jumping in the skies, so yeah, the lack of logarithm. Okay, it says it's setback, but okay, we can say that it's close to 0 except you are not. But completely by looking with the sheer luck, we were able to get to close to symmetric data points. And also we can see that kurtosis is still shrinking downwards. So now we have, okay, they are still yellow, but this one is, we can say that. It's also decreasing, so if we would like to have a regression model, then this is what behaves much better to define basic rules between the different variables, because we are not adding so many extreme values. So if we don't have extreme values at the previous levels, then also any regression will have higher chance to provide significant results. So this is how we can play with the p-values in regressions by lowering the frequency, and that's why artificial eliminating some of the extreme values. And now we have normal distribution. Wow. Here. US dollar. What else? Yeah. And autocorrelation, we can see that we also eliminated this. So it doesn't have a memory anymore. Okay, we should remember the previous quarter of years, so it's quite obvious. But heteroscedasticity, okay, this is still the yellow territory. But we can eliminate it. Oh, come on. We can eliminate it as well. Through this way. So for example, we are not able to fit Garch model on quarterly data in an efficient way. So sometimes it's running, but you can get a completely flat line. So it's not changing anymore. So if you would like to fit something on something, then you should use weekly or daily frequencies, because otherwise it will be quite useless. Okay, so that was the first slide, and I'm talking way too much about it, but it was necessary. Because after that, if we are going to portfolios, in the case of portfolios, we can see that the same thing is happening, so we could simulate this, but we don't want to. And we would have a relationship between the expected return and the quantified risk. But what matters more, that we can create a portfolio from that one. So if we are adding some weights to this, after that we can just, it is just a weighted average what we have at the level of the yield. But at the level of the variance of the portfolio, this is where things can go sideways, because obviously now we have okay, it's a mistake, so it's not squares. Yeah. So we have the variances, the weighted sum of variances, but also we have the covariances of the data. So they have to interact with each other. So they will have some kind of common distribution. So that's how, or this is how the entire agenda of the copulas were building up. So in the case of a copula, you are expecting that you have an n-dimensional, or right now 10-dimensional distribution for the data, and it's behaving like a cap or hat. That it has a nature, and it's fat-tailed in one direction, not so fat-tailed in another direction. So let's see how does it look like, because if we are looking for our data here, so let's say if data altogether, and histogram. No. Well, how was I able to do this? Because it looks so nice. And I know that I did it somewhere else. Maybe let's see the script. Yes, this one. Okay, sorry. Just... I recognize functional variable. Oh, maybe I should not remove the previous part from the script, but no, or plot matrix. Yes, this is what I'm looking for. Okay, so plot matrix. Not you. So this is where we can see each variable. So this is the first, this is the Brent oil, and its interaction with the second variable and the third variable and so on. And you can see each slice of this theoretical common distribution between the variables, how they are interacting with each other. And if you can see a line, then it means that they are in some kind of relationship, causal relationship. Or at least we can find a correlation between them, but we can see that they have something to do with themselves, with each other. If it would be just a circle, maybe like that one, or yeah, this one is much better. if it's just a circle like this, then it means that we don't have any clear trend or common trend between them. So it's just it's changing randomly, and who cares about it? This one is also. This is natural gas and all the other variables. So we can see that this is quite crazy. But in the other cases, we can see some kind of line if we would able to fit on them. And this is important because also what is described by this nature is the correlation between the variables. So the variance covariance matrix, what we can build up if we are doing this here, then it will describe how the variances, so the squares of the standard deviations, and also the covariances between the variables are defined. But it's quite meaningless for me to talk about only the covariances, so it's much more like to estimate the correlation from it based on that we know already that what is the value of the standard deviation here and there. And after that, we can see that practically this part of the book says that the correlation is constant. It's also not changing in time, so it's time invariant. And later on, that's why we need to estimate dynamic conditional correlation. And later on, the book will ask us to do that, so that we will enter a chapter to talk about this. And also, that's why we will talk about Gauss models later on during the semester, because this is absolutely not constant. So it's changing in time. So any kind of portfolio optimization will have its own setbacks or issues, because if this thing is not stable in time, then it means that this is also not stable in time. We also know that this is also not stable in time. So we have three variables which are describing practically the entire, okay, the V's are stable in time, but the rest is not. So that's why the risk of the portfolio will change also. It will be absolutely time dependent, and yeah, the correlation has its own nature. So even if they would be stable, then the rest is not. So so this is where we are failing to meet the requirements of diversification as well. Because diversification says that, okay, if we are defining the right values for the weights in the portfolio, then we can define a set of assets where the portfolio has zero or really close to zero variance. But since the correlation is completely or constantly changing, then we should change the weights dynamically. And we can create a well-diversified portfolio as well, just or transactional cost will be so high due to the frequent revaluation of the portfolio that at the end of the day it will be completely useless. So yeah, this is sad. But I was able to create this nice line when we can have the variance covariance matrix for the return. So let's estimate this. And now, yeah, so this is the variance covariance matrix. And this is why we should use logarithm of the data, but we are not using it, so who cares? And after that, we don't have to care about the different combinations, because we have this trio, which is the triangular matrix. So we are just taking the upper part of the matrix, so everything which is above the diagonal full of the variances. So this is the diagonal. And after that, it's the upper triangular, so that's why it's this U is here in the string. And we're just running it. We do not define the value, the weight. So It's not supposed to be 10 anymore because we have less than 10. Let's mess up the script. So yeah, it's bigger. Okay, so now we can see that the standard deviation of this portfolio is 5.2 because I did not use logarithm in the proper places. And yeah, it's 8 instead of 10. What is this port var? Yeah, okay, sorry. So we could do the same thing, so without all this magic, that just there is a portfolio variance function in the Matlab, and I try to be fancy just after that, forgot about this, but yeah, so Matlab knows this. Okay, so later on in the future, you can expect that we have many things to deal with all these flows and things, biases, what we were able to see. But let's go to the CAPM model, and okay, efficient torture is quite boring, so let's go to CAPM completely. So, as you can remember, again, we can define, or we can, we can create a decomposition of the expected return based on the systemic risk and the non-systemic risk. And okay, in the original setup, people were using the risk-free yield, so the government bond yields, yeah, interests, and also the we can say that practically the baseline level of the any kind of interest rates in the economy and also the market's performance. And after that, we can estimate the beta based on our friends here. So the standard deviation of the asset, the correlation between the asset and the market portfolio, and divided by the market portfolio. So again, beta will be also not stable in time because we can see that this is a correlation, and yeah. And also from the previous class, you can remember that, okay, if this thing is increasing, this is one of my favorite questions from final exams, especially at the level of bachelor. When, what is happening if this thing is increasing? And okay, it will obviously increase, just if we don't know the beta, then it can be tricky. If the beta is negative, then practically it can even decrease, but okay. It's always a great question for students. And after that, we have this example here. And these are the assumptions. So this is about efficient market hypothesis. And this is why we tested that this is not normal distributed. So we can see that. Forget the best thing. Come on. We have the data filter. So okay, let's remove this one. Don't carry this one anymore. And return. Let's see the real data. Create data set. Okay, close. And fitting. This looks quite ugly, so let's check another one because. Well, delete. Return, but not the first. Let's have the 8. It was the one of the stock market's DAX. Okay, data set. Okay. Okay, it's less crazy. Oh my god, just right now at the level of quarterly data. Yeah. Okay. Some additional changes. quarter anymore. Let's go back to daily levels because this is where ugly things are existing. Yep. And now data, delete, setting return is 8. So nice. And now we can see it graphically that what are the consequences that it's not normal distributed. So move it. Distribution normal, apply. Yeah, close. So the first problem is that around the expected value, so the market is way more lazier than it's supposed to be. So usually it's doing nothing at all. So yeah, it's 0. But after that, the normal distribution dies off. And after that, still we can find data points here, 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 and somewhere here as well. So we have way more. It's not the problem of just the mass of the extreme jumps, but also that things are happening which are not allowed by the model. So, and if you are fitting some stable, some kind of student-like distribution, then we can see that, yeah, this is what is fitting much better. The difference between fat-tailed data and heavy-tailed data set is that one of them is running out and the other is going to infinity. So it never reaches the 0. It practically it allows any kind of changes. Just their parameterization is quite terrible, but otherwise people are usually using them as synonyms. Just yeah. But you can see, okay, it's hard to see, so let's zoom in. So you can see here that things which are not allowed by normal distribution, they are allowed by the fat-tailed distribution. So, and since the early 2000s, this is the holy grail of risk management, that how can you define and fit distributions on the empirical data which will calibrate your risk management model well. And before the 2008 crisis, people were thinking that with the introduction of copulas and n-dimensional distributions, this was solved. Or at least it was assumed quite well. Just after that, they realized it was not. So it's still an unsolved issue, and I think that maybe it will remain like this one. So it's, if people were able to solve it, then it will be too easy to operate on the market. So there will be no crisis anymore. So come on. So we can see that, yeah, we are we have all these issues, and yeah, intersectoral correlation. So there is no intersectoral correlation, which is also a stupid thing, because yes, there are. And especially under stressful time periods, the correlation on the stock markets is increasing. So this is also a verified fact. We were writing a paper about it, but there are many papers which are supporting this idea. So usually not just inside the sector, but also between markets or between other assets. But we can find it easily. So if, for example, there is people are afraid of shares, let's say bank shares, and there is a financial crisis, then obviously all the banking shares, it doesn't matter. Even OTP, which had no idea about CD or CDSs before, during the 2000s, maybe since then, but they are way too conservative or low tech to understand it. But even OTP was going down by a lot. Mostly they went down from 10,000 forints to 2,000 forints. So yes, it was not just half, but decreasing a lot. So intersectional correlations are really important. So the error terms are not independent at all. And also risk-free rate, that we can use this for borrowing and lending. Obviously it's not working because the credit rating can be completely different, and also there is always a spread between borrowing and lending ratios, so it's also quite a romantic assumption. And there are also different investors, so some people or investors have long-term preferences, some others have short-term preferences. Also taxation was not added, and also homogeneous expectations. If the market network would look like as a lattice, then there would be no price changes at all. So everything would be priced in, and after that, if fundamentals are changing, then suddenly there would be some price change. But so heterogeneous expectations are necessary to have any kind of trading activity. So it's also quite flawed. And obviously, alpha can be the other holy grail of the investment market. So if a portfolio manager is exceptional, then they can have some excessive profit on the market, which is usually happening. Just the book is quite pessimistic at this level, so usually the historical average of the alpha is 0. So maybe some of the portfolio managers are exceptional, just usually it's a really small set on the market, or sometimes we can find specific strategies like value-based investments when you are looking for the fundamentally good companies which are undervalued, and then you are picking them up, and practically you are looking for mispricing on the market for structural reasons or for biases, and this is how you can deal with the alpha, but otherwise it's quite hard to find. And it's also quite a strange thing that before 2008, many investment funds or hedge funds were looking for the alpha, and they tried to create algorithms. That's why high frequency tradings and other schools became highly significant and important. And since 2011, we can see that they were giving it up, or some of them were giving it up. And nowadays, that's why ETFs are so popular, because in the case of ETFs, you don't have to do anything. So this is the most lucrative thing what a portfolio manager can do, because you are looking for an index, then you have to follow this index, so you are creating a close to similar portfolio by picking the significant shares to this portfolio, and after that you just have to count the commissions of selling this ETF to the investors, and this is quite stupid, but also it works. So we can see that nowadays the ETFs are one of the most significant investors on the market. So even in companies, they have a significant share package, so sometimes they are above 10%. So they can delegate board members. At the same time, they have absolutely no interest in the company, so they don't care about that this company is profitable or not. For them, what matters is that they are in the index. So yeah, it's strange. Okay, arbitrage pricing theory. I can't say this is a theory. So whenever I was able to meet this concept, it would suggest that we should add further variables. But if you are reading about APT, it's always that, oh, we should add some macro variables, like GDP, like inflation, like interest rates, and after that nothing else. So it's not a reinforced theory like a CAPM that, okay, this variable, and that variable should be added. Just, yeah, there can be macro bias in the data set, so let's add macro variables. Okay, and after that, what is happening here? So that's why arbitrage pricing, I don't know, hypothesis would be much nicer, because this is far from a coherent theory. And it doesn't matter that we are looking for this book or the oh, what is the other? The with the B, whatever. So if you are looking for other handbooks, still the problem is the same, that they are always avoiding this problem. And also they are saying that we should add also bankruptcy costs. So what is happening is this bankruptcy cost can be direct costs or indirect costs. So problems with the valuation, also uncertainties, because how can you value in intangibles? This is what we were able to see in the previous semester, because the company had enormous amount of intangibles, but some of them maybe are completely useless. So how can you differentiate the trademark in the balance sheet that this is intangible, or patents, or maybe royalties, which are owned by the company? So intangibles can be completely different. And in the level of how can we liquidate them. Also, lawyer costs during bankruptcy, accounting fees, customers, suppliers, and the problem is that sometimes liquidity just can dry up. So this was also a main lesson of the 2008 crisis, because even if the company is solvent, if nobody would like to buy their bonds or short-term papers, commercial papers, still they can have an issue, or maybe also they are not able to get a short-term loan from a bank, because banks don't want to provide a loan. So it can be also a problem, because this is what you are not able to model at all. Yeah. So the book says that we have two options: risk decomposition or risk aggregation. So this decomposition says that, okay, we should define limits. So trade limit, client limit, also to limit the position what an individual manager can take, and that's why we would like to avoid big risk. Yeah. Animals are here as well. He looks angry. And even in Basel criteria, already in Basel 2, but since then in Basel 3 and 4, there were also limits for banks to taking the big risk. So at the level of positions, and also at the level of key owners behind companies or management. I remember these two things or three things. So it's not just about companies, because obviously they would be able to bypass by creating a subsidiary, and that's why they have to be more careful. Risk aggregation is the diversification. What I was saying, that okay, but if correlation has a changing nature in the underlying data generating process, then we have issues. But in the case of insurance, so insurances are usually not working or not covering catastrophes. Okay, in the case of US, you are able to find products which are securing the company against hurricanes or other things, but they are specialized insurances. So usually they are backed by a secondary bond, and in this case, the bondholders must cover this. But otherwise, that's why we have state. So if there is a catastrophe, then insurance companies would not able to. You have to liquidate the entire insurance company to cover all the issues, and usually it's written in the insurance contract. So when now it's a year ago. So when a year ago we had to create an insurance for our new flat because it was required for the mortgage. Okay, the new flat, so for me it's a new, but otherwise it's existing for 30 years now, the building. And also it was written there that in the case of a nuclear war or civil unrest or whatever, I was looking on the contract that, okay, maybe in the case of a nuclear war, the server with my mortgage on it will be melted in Budapest, so I don't have to care about this anymore. So when I will ride my motorcycle like Mad Max, then I don't have to care about the mortgage. So that's why insurance, yeah, it's tricky. But by diversifying, they can deal with. Credit risk is the other thing, because also 2008 crisis was teaching us that it can happen at the same time. So even if things could look like separated in peaceful times on the market, but if a specific sector is affected, or sectors are affecting each other. So 2008 crisis started with or as a financial crisis, but once financial services like lease started to freeze up, then immediately car manufacturers, or truck manufacturers, were facing troubles as well, because uh, people were using lease contracts to get fleet of cars or individual cars. So it started to spill over to other sectors. And the spillover effect, this is really hard to model. So even in case of credit risk, you could say that, okay, I'm diversified in different sectors, but if they have an underlying hidden relationship with each other, then yeah, it can be a problem.